How did that work? How did you do it?
So the way that I'm running it is a funnel. So I am setting up all my funnels and forms and everything
Hmm.
through Go High Level.
Hmm.
And then I am using Google Ads to run those. So I set up a custom form.
Do you mind sharing the funnel and the form so we can
Yeah.
kind of see with it? Would you, because I think we've got a couple of other inquiring minds that would love to see this.
So here's my funnel.
Uh-huh.
I have my landing page and then I've got the form and then they can book an appointment directly with me and then I've got my thank you page set up. Um,
Cool.
and this is all this text and everything, Chat GPT.
Hmm.
All my pictures and things like that, I use Canva for.
Hmm.
But this is that, so if they click on my ad, this is the landing page that they'll come to. And I've got, all sorts of buttons set up. Like these will take them
Hmm.
to form. These will take them to book with me. But I mean, it's really simple. Just it gets the information out there. I've got some FAQs, things like that. And
Hmm.
if they do all of that and then go and do my form, this is how I have my form set up and all the like initial questions that I ask.
Look at that. Look at that. Okay.
Mhm.
And you said that you ran that. When did you start running them?
When did I start running them?
This weekend?
Yeah, like it's not even been a week.
Okay. And you've gotten six so far?
Yeah, six so far, which I was running FEX leads and general life on Facebook. Um,
Yeah.
and I got three leads off of those, and I was running those for 3, 4 weeks.
Oh,
Uh,
wow.
yeah, so this has been way more lucrative than
What's your lead cost roughly? Is it too early to tell?
so I did some tracking wrong, so it's got me at a higher here's my Google ads though. Uh
Hmm.
so it's got me at like 82 cents cost per click.
Hmm.
Um but like down here I had my conversion set up wrong at first. So it has
Okay.
me at 11. But let's see, because I think what did it say? I spent 315, so 319 so far,
Hmm.
and I've gotten six leads. So I'm at about $53 a lead.
And my guess is that that goes down the longer you're doing it
Yeah.
and, tweaking things. That's
Absolutely.
fantastic.
Yep.
That's absolutely fantastic. Nice job. Thanks for sharing that because I
Yeah.
think a lot of people really, really, really want to.
So Scott, and I jumped in at the end, but it was good. Good job, Sarah. How was the conversion on those? Have you got appointments off of them yet?
Yeah. Yeah. So that's what we were talking about is I've gotten six leads off of those so far. Two of them have already set appointments with me.
Neat.
And the other four, I have to reach out to and see if I can schedule appointments.
Okay, good. That's good conversion numbers. So we'll see. Good job.
Yeah, fantastic. Okay, guys. Well, I know that there has been a change in the timing that we're doing this, and I appreciate everyone's flexibility. It's either you're super flexible and you absolutely love advanced market masters training and you would stop everything for it, or you're not busy at all selling and you had nothing but time. Either way, I am thankful that you're here. Hopefully, it's the first and not the latter. But yeah, this is going to be good stuff today. So, looks like who do we have on here? Miss Jackson, Mr. Fred, Michelle. I love when we have two Michelles on here. I love it because then I just say Michelle and both of them look up. Shirley. I don't know if I know Shirley. Do I know Shirley, Darren? I don't know if I
Um,
do. How are you, Shirley?
Hey, I had come on with Brock probably at the beginning of the end of last year, beginning of this year, and then
Hmm.
I had to do some things with my mom and her health, so it's stabilized, so I'm
Well, good.
getting back in the
Okay.
groove.
All right. Very good. So this is just for those who are new and those who are not new. Hopefully, you know that this is our Advanced Market Masters intro training. And what we're going to be talking today is going to be a concept. We are not going to talk about life insurance. What? How is this possible? We are going to talk about the infinite bank concept as a concept. What does it mean? Why is it even a thing? How does any of it apply to life insurance and all of that stuff? Uh, Miss Lee, everything
Yes.
good with the plumbing? Everything good with the plumbing?
Yeah.
We good?
Yeah, they're still working on it. So the plumber's there. They just needed to talk to me for a bit, but we're good.
Okay, good,
Sorry about
beautiful.
that.
No problem at all. I just want to make sure that. Okay, so for those of you who can turn your cameras on, I would appreciate your cameras turning on because I like to talk to pretty faces, and I do not like to see, um, not pretty faces. Okay, infinite bank concept. Here's what I want to talk about. If you were to talk to someone and say infinite bank concept, and they said, "What is infinite bank concept?" I want to hear, and I'm going to pick a couple of folks here. If you want to answer, you can raise your hand. I want to hear how would you answer them? How would you answer what infinite bank concept is? And Michelle Lee, since you are unmuted, thank you so much for volunteering. It makes it just a lot easier. So go ahead. What would you say?
You're just your own bank. It's where you can contribute money into your own policy, sort of like a savings account, but um, it compounds interest and you can accumulate cash value on it.
Okay.
And at some point, you can receive that money tax free.
Okay. Okay. Gail, what would you say? Thank you, Michelle.
Mhm.
Uh, Basically the same thing, infinite banking concept. You're able to deposit your money into the account and withdraw from the account as well, but it gaining compound interest while it sits there. I'm really not
Okay.
that sure.
No, that's okay. By the way, Gail, love the do. I gotta say, whenever you get back from the salon, man, your
Oh,
hair is
fancy.
on point. I
I do
absolutely love
it.
that. Oh yeah, the
Go ahead.
Augustine salon. Yeah, I was gonna say. All right, so John, anything you want to add on to that, buddy? He's got to find the mute. There it is.
Yes, got it unmuted. Yeah. I would just start off with something simple about how would you feel about taking more control of your money? And of course, it'll generate like what's he talking about? Maybe they'll give me a couple of questions here and there that I can kind of go into it, but I'm not going to go for the next 10 minutes explaining how it works. It's just whether or
Right.
not you pique their interest.
Yep. So basically, I want us to understand something. The infinite banking concept, it's a strategy. It's not a product, right? We understand. I hope we understand that. If not, please understand. Infinite banking concept is a philosophy. It's a strategy. It is something started by whom? Who was the founder? The father,
Nash, Nash.
Nelson
Nelson
Nash.
Nash. I think it's R. Nelson Nash. He's one of those guys where he didn't say his first. It's like he used his middle name, but he wanted to sound fancy, so he used the first letter of his first name. R. Nelson Nash. The concept is basically this, that you, instead of, there is a cost to spend your money. You're giving up income if you spend your money. Now imagine me saying that. Imagine me, Carrie, if I, yep, okay, you're losing money by doing that. So you guys, first of all, you're probably going to be, what are you talking about? You're losing money. Remember this. If you are not making interest, you're paying interest. If you're not making interest, you're paying it. It is that simple. If you have cash, has nothing to do with life insurance. This has nothing to do, this is economics, and most people do not understand this. If you have cash and you are not making interest, you are paying interest. You're sacrificing interest. What do I mean by that? Does someone want to jump on and say what they think that means?
Basically, your money's going down the drain and you're not putting it into an account where you can compound your interest and borrow against it. Yes? No?
I didn't hear. I'm sorry. Say that one. Darren, do you mind muting for me, buddy? Thanks,
Sorry,
man.
man.
No, it's all right. Go ahead, Michelle, one more time.
So basically, if you're using your own money, it's just going down the drain. Whereas you can take your money, put it into an account, an investment account where you can compound interest and borrow against it. And the money that you've put in there, it's going to be in there to build interest on top of that.
So basically what she's saying, and I want everyone to understand this, if we take money from our paycheck, where do we put it? Where do we put our money?
Bank account.
In the bank account. In the bank, right? That's where we have been taught, and we have been basically it's just part of who we are now. What do you do? Oh, I put money in the bank. How much money are you losing by putting your money into the? Do you go to open up a bank account and say, okay, we're going to negotiate. I'm going to give you my paycheck and I want 5% on everything I give you. And what are they going to? No, I'm not doing that. This is what you get: a checking account with 0 interest, but you get free checks. And that's what you get. Okay. You are giving up the power of your money. You're paying interest. Well, how are you paying it? Because you're not making it. You're sacrificing your own interest. So remember that. If you are not making it, you're giving it up. You're paying it. Okay? Because you have made a decision. If I pay a bill that's $200, am I ever going to see my $200 again if I do it the way that they want us to do it with the bank?
No.
Now, what if the concept was I have my $200 and I'm not going to spend that $200. I'm going to put my $200 somewhere. I'm going to have that make me money. And then the money that's making, I'm going to take that $200 and I'm going to spend that. All the while still having my $200 collecting interest. That is infinite banking concept in its simplest form. So I'm going to show you guys something. Okay, why is it as soon as I start doing these calls, people text me and say, hey, do you got 10 minutes? And they call me and they text me. Well, I don't understand. Okay, here we go. Ready? I'm going to share something to you. This is a very specially designed. This took me a while to come up with this. So I hope you guys love my. Can you see that? That's pretty impressive, isn't it? You realize how long it took me to put this together? What normally happens here? You guys can see this? Tell me this isn't the average American, the average person you know. It could be you. The numbers may change, but this could be you, right? You get a salary, you're working somewhere, and you bring in net about $100 or $10,000 a month. Okay? And then with $10,000 a month, what do people do with their money? Well, I'm going to go and I'm going to pay my bills because we all need to pay our bills, right? Yeah. No, we all need to pay our bills, right? So that's what we're doing. We're going to pay our bills. So what are we going to do? Well, first thing we need to do is pay my mortgage. My mortgage is $2,503. So I'm going to take this money that's in the bank and I'm going to write a check for this. Or I might not write a check. It might be they just pull it out because that's where we are now in 2025. Most people are yanking it out of our account. Then I have to pay for my BMW. Then I have to pay for my wife's and not quite as big BMW. And then we have a couple credit cards. Yeah, we're making payments on it. It's not a big deal. We can afford it, and because this is a couple of vacations we took or whatever else, and things got tough during COVID, and water's wet, rocks are hard, all this other stuff, and so here's my credit card bills. We had a personal loan of $450 a month because we got into some, a little bit of issues while I was looking for my other job, and we just had to take that out to survive. Student loan still of $649. So right now the debt is $5,676. And by the way, most people would think, yeah, I can afford that. I make 10 grand a month. I net 10 grand a month. So I can spend 5676, not a big deal. Right? I mean, if you were to sit down with someone and look at this financial picture, would you agree? Would you disagree that this is kind of normal? And then, yeah, we have utilities. Let's say they're $1,500. And under utilities, obviously, you've got like internet and cell phones, movie channel subscriptions, all that stuff. Then food, $2,000 a month. How many people think that's high? $2,000 a month. Well, Gail, it's just you and Fred though, right? Tracy, is it so? But let's see here. Steph, you think that's really? Carrie, how many kids do you have at the? Oh, you don't have any at the house now. Steph, you got how many kids at the house?
3.
And what would you say should be an average grocery bill?
Probably half that.
Really? Man,
I'm
my
gonna
wife and I,
chime
my
in
wife and I
because
spend over $1,000 a month on
yeah,
groceries.
I was gonna say I've got 3 kids, and we spend close to 2,000 a month.
Yeah.
I was gonna say
Yeah.
I have 3 sons and it's about the same for me.
Yeah.
Yeah. So the thing is, some people will say, "Hey, I can get by with less than that," but I don't know. Like I find where we are right now, of course, I like ribeyes, so that could be it too. But where we like, it's about $2,000 a month, I think, is close to what we're spending. But anyway, so then we got miscellaneous. We got $500 just for stuff we did, car repair. We needed tires, whatever the case is. And so the total cost is $9,676. And this is what normally happens, right? Well, we have our bills, and then I try to save whatever I can left over. I'm going to put a couple $100 into the savings account because I need to feel good about myself. Does anyone talk to anyone who is very, very different than this, or does this kind of seem like just about everyone you talk to in real life?
Everyone.
It's about everyone, right, Lisa? It's about everyone. So this is what I don't know here. Let me see something. I'm gonna try to get real creative. You ready? Annotate. Whoa. Now watch this. I'm gonna see if I can do this. I'm gonna draw. You guys ready? We're getting this on camera too, so this is gonna be awesome. This is video. I need to make this bigger first before I draw. Please hold. There we go. Okay, see, this is gonna be my drawing space, and now I'm gonna draw. All right. Are we ready? Let's see here. Let's go red, shall we? This is going to be great. You guys are going to make fun of my third grade writing skills and drawing skills. Here we go. This is the bank. All right. And we take our money and we put our money right there. And then from here, we do this. Pay everything. And then the difference, if we're lucky, that gets saved into a savings account. Now, you guys ready to hear something crazy? If you're saving money, you're broke. You're poor. You will never build wealth while you're saving money. Somebody argue with that. Somebody argue with that for 2 seconds. You will never make money if you save it.
Is it because it's in a savings account and they're making interest off of it and you're not?
Think about the saving is almost, well, I'm going to tell you this, it's identical to hoarding. Why do people hoard? How many of us are hoarders, self-admitted? Okay. We're hoarders. All right. Why? Why do you think, Michelle Lee, why do you feel why did you call yourself that?
I we hoard because we want to hold on to things and not lose it.
Okay.
It makes,
Sometimes I'm sorry, someone else said something. Who was
I'm
that?
sorry,
Sorry.
It's
sorry.
like fear of lack.
Okay. Sarah?
It makes you feel good.
It makes you feel good. Now, let me ask you a question because to me, when I see someone hoard, like for example, my father-in-law, I don't think he'll ever watch this. My father-in-law, my wife is so different than my father-in-law. My wife literally will throw everything out. Like if it sits there for more than 2 minutes, you're not using it, it's in the trash. My father-in-law has 5 different barns and or sheds on his property because he can't get rid of stuff.
Hmm.
We might need a wheelbarrow that's got 4 holes rusted out through this thing. We might need it, who knows? So we're going to keep it, right? The point is, there's normally another reason behind why people hoard and save. A lot of people, well, let me ask you this. Why do chipmunks and squirrels hoard? Think about this a second. We're getting real deep. And if you guys are not chipmunk experts, let me know because I can turn you on to a couple good books. Why do they hoard? Why do they grab all their nuts and their things that they want to eat and they do what with
Storing
it?
it up for hard
They save it for
times.
later. Yeah.
There you go.
Rainy day.
They are being cautious because they know what's going to happen or they fear what's going to happen, which is winter. This stuff isn't going to be growing. So therefore, I am going to do something now just in case. In other words, there's a 4-letter word. It can be a positive thing, but not always, and that's fear. If you save your money, you are not growing your money. All you are doing is you are conditioned psychologically to try to keep from going through something that you have in your life that you've experienced, whether it's been you personally, whether it's been your family, your mother and father, whatever it is, there's a reason why. And this is how we have all been conditioned. I mean, I'm not picking on anyone here. This is how we've been conditioned, right? What did mom and dad first tell us? What did mom and dad first tell us when we were 10, 11, 12? Remember? We're going to take you down to the bank and we're going to get you your own checkbook. We're going to get you your own checking account. We're going to, right? We're going to do that. And then and then you're going to put money in. And then you can, every month, you can look at the statement and see it's the same $5 that's there, or now it's $5.01, right? Or whatever it is. And you keep doing that. You've been conditioned to do that. This is the problem that we have is that when you give the money away, I'm going to come back to share it here. When you give this money away, oh, it didn't keep my thing. Oh, bummer. Okay, whatever. That's all right. You lose anything that this could give you. You lose this. Now, let me ask you a question. You put this in the bank. I'm going to come back up here and get my bank, right? See, Shirley loves my artistry. This is hard to do on a mouse, guys, just so you know. I've never been okay. You know what we could do is we could do the quadrilateral thing. Remember, like we used to do in high school, or anyway. Okay, whatever. That's my 3-dimensional bank. All right. What happens is this $10,000 it goes in here to pay all of this. How much do you get from this? If I was to put this in here, and then I took this out and I paid
Percent,
all my bills, what's that?
like 0.5%,
Okay,
maybe.
so let's say maybe I was getting 0.5%, right?
Can you move your thing to the other side a little because your head's in the way?
My
Yeah,
head's in the way.
yeah, there we go. Now we
Why
can
is my
see
head
everything.
in the way? Why is my head in the way? Oh, dirt. Sorry. didn't mean to do that. Let's try that again. Okay, I can't get out of this. I'm trying to annotate on. Oh my goodness.
Right there is good. It's fine because we can see the numbers.
Yeah, I don't know what I'm doing now, so I'm gonna have to do this one more time. Here we go. Okay, I'm done. I'm done writing because I keep losing. Is that better, Michelle? Is that okay?
Yeah, that's better.
Okay. Anyway, so here's my point. You get 5%, 0.5% rather, half of a percent. That's what you get. So how much is half of a percent on $10,000, kids?
I don't know, $50 maybe.
Okay. Anyone have anything different?
No, $50.
50? Anyone else?
50,
50?
what,
Yeah.
I'm thinking
0.5%?
five. I'm thinking $5.
Mm-hmm. Yeah. So don't forget it's 0.5, not 5. It's $5. And that's in a checking account, by the way. Now, if you look at in no checking account gives you half a percent. They just don't. So, but let's assume for a moment that we made $5. Okay. How much do you think the bank makes on this $10,000 that we have put in there? Shirley, what would you guess that the bank makes on that $10,000 that you have just put in to your bank because you got to pay bills? Take a guess, Shirley. How much do you think that bank would make on that $10,000?
Um, to probably about 500 or so dollars. They probably be getting about 11% somewhere on something.
Okay. Okay. No, that's fantastic. Listen, this is the truth is that over a 30-year span, the bank makes over 5,000% on every dollar you give it. So for every dollar, they make $5,000. And they have who to thank for it? You. So what we're doing now is we are trying to harness what happens to this right here. Is there a better way? Now, the first thing I'm going to tell you is that infinite banking concept is not for everyone. Because the rule of thumb, and by the way, for those of us who have been kind of attending my classes, I think you'll remember this. I hope you do. If you don't, I'm going to be really upset. What is the rule of thumb for a 20 or 30-year-old to invest out of their annual salary or monthly salary?
10%.
Okay, John says 10. Anyone else have a guess or something would disagree with John? He's harmless. He's not going to get mad. He's a teddy bear.
20 to 30%.
20 to 30%, Carrie says. Does anyone have any different suggestion than that? Okay. Actually, my recommendation to anyone who is in their 20s or 30s is you need to save 20% of your paycheck. You need to, and by saving, I don't mean putting it into a bank account and storing it until it snows. Now, if you want to do that with an emergency fund, fantastic. Go ahead because there's two types of things that are happening. Anyone watch football? I hope you do because if you don't watch football, we cannot be friends. There is two sides of the ball. What are they?
Offense, defense.
Offense and defense. Now, if we were going to be making money on our money, what would you consider that? Would that be an offensive strategy or a defensive strategy?
Offense.
Offensive strategy. We are making it happen. We are moving the ball. We are doing all of that. Now, an emergency fund. What is an emergency fund? An emergency fund is only for, the name kind of gives it away, emergencies, right? And so we don't necessarily want to worry about making money on an emergency fund, because emergency fund, is that offense or defense?
Defense.
It's defense. It's protecting us. It's allowing us to be able to go back and grab some cash really quickly and for whatever emergency. The furnace went out, the fridge broke. I need a new golf club because my wife broke the other one. I don't, whatever it is. Okay. That's an emergency fund. So that's defensive. So what we're talking about now is we're talking about what is the better way to do this. So 20%. Oh my goodness, guys. Don't ever, I hope no one watches this afterwards, because this looks like I'm having a seizure, by the way. 20% is what we're trying to save. Now, if a person saved 20%, is this person here on that same level? Take a look at what they're doing. And what's the first thing you would see with this? What would you say? Are they, if this person was in their 20s or 30s, do you think this recipe, they would qualify for infinite bank concept?
No,
No.
Why? Why?
because if you're
Suitability.
saying, go ahead.
You're paying out more.
You're
They have
paying
less than
out more.
20% to set
Okay.
aside.
Okay. Which means what then? What would that mean, Michelle? Why would that matter?
Well, for infinite bank, you have to have time and money, right? So they don't have the money. I would probably suggest a participating whole life, right?
Well, potential, I mean, participating whole life is what you use for infinite banking.
Rather than an
Um,
IUL.
yeah, I mean, so, but the point is, something's got to change here, doesn't it? Something's got to change here. And now, this is where we can get into debt-free legacy, because all of a
Yeah, I
sudden
was,
now we're able to do that, right? But at the onset, when someone says, "Oh, I want to start saving money for infinite bank," well, again, we ask the question, what's the money for? And you're not going to get anywhere saving 324 bucks. Take it back. You will. It's just going to take you a long time, and you'll be able to finance a computer in 3 years. You know, that's kind of what we're talking about, not buy a piece of property. So 20%. And this is the strategy now. Okay. That 20%, what they're going to do, this is infinite bank. This isn't debt free legacy. This is infinite bank. That 20%, they are going to go put this into a vehicle. I'm going to put tires on this vehicle, or it looks like a radio or a TV, an old one. They're going to put this money into this vehicle, and they're going to put that here. And this is going to give them, let's just say, 10% per year. Oh man, Lord help me. 10% a year. You guys understand that? Is that okay? Believe it or not, I'm drawing this with my right hand. I am right-handed. This is just a. I am, for those who care, I actually am getting one of those electronic whiteboards, so I'll be able to do this pretty soon on these training classes by writing this stuff down and going over illustrations. They cost $3,000, so I'm just waiting for Michelle and Gail to write more policies, and then I'll be able to do that. But anyway, so 10% a year. Now, what's the difference here? If this person put in 20% of their income, which would be how much
2,000
per
paycheck.
per paycheck or per month,
Per month.
how much would that be for the year?
24.
24.
24,000. What is 10% of 24,000?
2,400.
2,400. Do you see the difference between the way they're doing it here and now looking at what we're doing over here? 2,400. Okay. Well, this person can't save 20%. All right. We'll talk to them about how they cut this stuff out. But until then, this is how we give people advice on how you, by the way, I've had this conversation with every one of my children first starting out. You save minimum 20%. You give minimum 10%. You get to do the rest of what you want with 70%. But this is what you give to church, 10%. You don't give to church, then give to another organization. Give 10%, save 20%. You've got 70% left to make things work. By the way, folks, we don't need most of the stuff we get. You understand that, right? We don't need most of the stuff that we have. The things that we're paying for that we bought 4 years ago still on that credit card, I bet you can't even tell me how that tasted. You know, I bet you can't even tell. But so anyway, that's a whole, I digress. All right, so 2,400. That's what we got per year. Now, the next year, if I do the same thing, how much do I have? Another 2,400, right?
Wouldn't there
Right.
be compound interest?
Ah, so how so?
Because it's in a, isn't it in a participating whole life policy?
This here, I'm just putting into whatever vehicle
Oh,
is.
okay.
Yeah,
Sorry.
but that's okay because there is going to be
Okay.
potentially, there has to be because the next year, when I put in again this amount, so that's now 4,800, right? So
Right.
so we're going to get 2,400. That is our 10% interest. Then I'm going to put another 2,400 in, and I already have 2,400 in there. So what's that going to be?
48.
4,800. Then the next year, I'm going to be putting in 2,400 and I'm going to be getting 10% interest. So what is that going to? Because I'm putting in 24,000, 24,000, 24,000. The thing is, the first year when I put in 24,000, oh, Lord help me. I think I have Tourette's. I honestly I feel like I do here. So, okay, 2,400. Now we're going to add this to the 24,000. What's my balance? Is 26.4.
26.4.
Right? 26.4. Now, what is my interest on year two at 10%? Is it 2,400?
26.40.
It's 26.40. You guys see that?
Mm-hmm.
Now we add 26.40 to this. What are we talking about? We're going to make you guys do some math here.
29.40.
9.40.
29.40. That's a 9, by the way. Okay. Do you see how it grows more than just 24, 48, right? You see how it adds onto it. So this is now your interest. It is compounding from 2,400, and just in 3 short years, you've made an extra $500 on compound interest, not the simple interest that you get the 10% for. Okay. Here is the concept. And I'm going to stop this because I don't think this is helping anyone with that. I thought I would try it, but oh well. This is the concept. You are going to make money on your money. That's what the compound interest thing is. Okay, everyone kind of follow that. You're going to make money on your money. So therefore, what we want to do is we want to take our money and have it work best for us. Instead of putting your money into the bank, we're going to add a step. What step is that? What is it we're going to do first? We're going to get our money to work better for us. So instead of putting it into the bank, we have to put it somewhere else where we're going to be able to get 6%, 7%, 8%, 9%, whatever that percentage is, we want to get, because why would we give that up? Think about that a second. Why would we give up the opportunity to make money besides the fact that we didn't know anything about this? Is there any other reason? Would anyone out there say, yeah, you know what, I just don't want to make money?
I have one.
Yes.
Health, your health. What if, the person went through a lot of medical issues and that's what we got going on now.
Well, so that might keep you from getting a policy, but that's not going to keep you from wanting to make money. Do
Right.
you see do you see what I'm saying? So the
Got it.
question is, everyone wants to make more money, right? We just don't really know how to. Well, how do you? I mean, because this is how I've been taught. It's ingrained in who I am. You put your money in the bank, you pay your bills, and if there's something left over, you save it. Well, instead, what we're doing now is we're going to say, all right, first of all, we're going to take 20%. If you can't do 20%, then we've got to correct that immediately because you won't qualify for IBC. You might qualify for debt-free life. Let's take a look at that. But you are not going to do this. So business owners, folks, and those kind of folks out there, they got to be able to afford this. They have to be able to. It's like within selling, if people don't have money, you kind of don't want to spend a whole lot of time on it because they don't have the money, right? So once you understand, okay, we got 20%, this is what we're going to do. We're going to move that money, or instead of 20% savings, the other option is if I'm paying debt to someone, I'm going to pay myself first. So do you guys remember how much debt by chance? I want to see how much you guys are paying attention here. How much debt was showing my monthly fee on my bills? Do you remember? How much of it was debt? Ooh. Wait, who was
Then
saying that?
utilities. Utilities and everything else came out to like 96.
Yeah, forget utility, just the debt though. Do you guys remember what that was? We're close. Sarah, you were saying
Roughly five.
Six something. I
50.
want to
Good.
say 56, 46.
Good for
Yeah.
you, Sarah. Holy cow. Nice. Okay. Yes. Yes. So $5,600. Okay. So let me ask you this. What if instead of taking all that money and sending it to the credit card payment, sending it to the credit card companies, sending it to the banks, the financial institutions, the mortgage lender, whoever it was. What if first I took that and put that into my own bank that made 10%, and then immediately I took money out and paid my bills? What sense does that make? Why in the world would I do something like that? What sense? Someone. Come
You
on.
can pay it off faster
How?
because you're using the compound interest
Hmm.
in your life policy. You're still borrowing your own money and
So,
bank's money. You're making your money work for you.
okay. Specifically how?
Paying yourself first.
So, okay. Well, it's the same as paying yourself first. Yeah. So I want
Right.
you guys to understand right now, this is what's happening. If we take that money, put it into, I said I'm not going to talk about life insurance, but in this case, okay, let's assume a participating whole life policy because that is what we use for infinite banking and debt-free life for the most part. Okay. So we're going to put that money there.
Right.
And all of a sudden, now, let's see, the money goes in and I need to take money out because I got to pay these bills,
So you borrow from
right?
yourself.
I borrow from myself.
Well,
From
from the
the bank.
policy.
You borrow from your
So
policy, yeah.
there we go. This is the one thing I want to tell you guys, and the details matter. So please hear me on this. You are not borrowing your own money. Whose money are you borrowing?
The insurance carrier.
Insurance company.
You are borrowing money from the insurance company, not yourself. So what does that mean? That means that if I had $10,000 sitting in my account and I borrowed $9,000, how much money is that 10% interest going to apply to?
On the 10,000.
10,000.
Well, if I took $9,000 out though,
Yeah, but you borrowed it from the insurance company. Your money's
ah,
still in there.
ooh, and there is the ding, 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 ding moment that we all need to understand. Gail, I'm so proud of you, dude.
Say that one
I'm
more
Me
time.
telling you,
too.
man. I am so proud. Okay, so this is what happens when you take when you have any kind of cash building policy, like participating whole life or IUL, and we'll just use the number $10,000. And I need 9,200 to pay my bills or to pay my debt. So I'm going to put $10,000 in there, and then I'm going to immediately grab 9,200 out. In my insurance account, I'm going to make roughly cash on cash about 10% a year. So if I put in 10, took out 9,200, and I'm making 10%, what am I making 10% on?
You're making 10% on 10,000, which gives you 11,000.
I'm making 10% on the
What you put in.
10,000, which is now 11,000. Well, how come it's not only on 800? Because I took 9,200 out.
But you didn't take 9,200 from your money. You took
There
it
we
from an
go.
insurance carrier.
Insurance carrier. Hey, has anyone ever taken a loan out for anything? You guys ever taken a loan out for anything? Do you guys, how much paperwork do you have to do on that? Got to give them your social. They got to run credit checks. Then they come back and say, hey, the rate that we said we were going to give you, yeah, you forgot to pay a bill in high school, so we're going to, make the payment more money, right? And all that stuff. And it's a pain in the rear end. It's like they're doing you a favor for charging you interest. Do you guys realize when you have a life insurance policy and you need access to that money, do you realize the credit application process? You guys know what that is? Zero. It's not. There's nothing. You're guaranteed to get your money. Why and how? I want to hear us answer this now. How are we guaranteed to get that money as a loan? What if our credit's horrible? How do we get it? Why would they give it to us? Because I'll answer. Because with life insurance, what comes with life insurance? With every life insurance policy, a death benefit.
A death benefit.
Every life insurance policy comes with a death benefit, right? And so this is what the insurance company says. Okay, when you die, we owe you 100,000. So we're going to give you a loan for 9,200 because you got 10,000 in there. And if you don't pay us back when you die, we're taking out of the death benefit. So that is what we call collateralized loan. They use the death benefit as your collateral. So is the insurance company really on the hook for anything? Not really, because they're guaranteed to get their money back, right? So once you put in 10,000 and we're making 10%, Michelle said that's an extra $1,000 a year. So now it's 11,000. All right. Well, then we put in another 10,000 year 2. And that 10% is on what?
11,000.
The 11,000 plus the 10,000 you put in. So now you have 21,000 and you get 10% on that. What is that?
2,100.
2,100 bucks. So now what's my total? 23,100. That is compounding interest. And Shirley, if you want to know, the power of compound interest, I'll tell you this, and then you can kind of just like play it out in your mind. If I had, and I know most people who've been on here have heard this story before, but Shirley, since you're newer with me here, we're going to give you a free sneak peek, and no one else can answer this. If I had $1 and I gave you $1, and I said, Shirley, let me ask you a question. If I said to you, I will give you $1 and I will double what is in your hand every day, or I'll give you $250,000 for 20 days. In 20 days, I'll give you $250,000, or I will give you $1. And day 1, I'll double it. So now there's $2. And day 2, now it's $4. And day 3, now it's $16. What do you take? You've got 5 seconds. Make your decision.
Well, no, I would say the $250,000 and the what is that, the 20, 30
Yeah.
days? Yeah.
Yeah, the 20 days. So $250,000. You're like, no brainer, right? No brainer. I'm
Right.
going to take that. Okay. Do you know how much money you just lost?
No.
$750,000, because that dollar doubled every day for 20 days is $1,043,000.
Oh, wow.
That is compound interest. So we're taught what the exercise we're going through is just taking
Okay.
us through 2 years, 3 years. You wait until this thing takes off. That's how, folks, we're getting after year 30 on some of these policies. That's how we're getting 100% cash on cash
Mm-hmm.
returns, because the compounding effect is so big. Okay, so infinite bank concept. Infinite bank concept. I wanted to talk about the theory of it, not what we're selling, but the theory of it, because what we need to be able to express to people, or we need to be able to educate them, first of all, just about finances in general. We need to understand how money works. And the banks are the richest industry in the world. And they have developed this using whose money? Their money. Like your money, not theirs, your money. Sorry. I was just admiring Gail's haircut again. I got sidetracked. So it's
Yes, and
you're
our
there.
money.
They are using Gail's money for all of their, every bank uses her money. That is how, but seriously, that's how banks work. So, infinite bank concept, we flip the script. We're going to recognize spread and arbitrage. And that is how we're going to get this to work for ourselves. So, for example, if and I can do this next week, if you guys would like, in fact, you know what? I think I will. I'm going to show you what a sample. It's not going to be exactly my own policy, but it's going to be a sample of what it looks like. And I'm going to show you how we have, here is the death benefit, here is the cash reserve, here's how much money is making me other money, and you'll be able to see how an infinite bank concept, properly structured policy would look. Would you guys like to see that? To see, well, yeah, what does this look like when it grows up, right? Like, would you like to see that? Would that be helpful?
Yes, please.
Good. Good, good, good. Okay, let's throw it to questions. I know this was quick. I know there was a lot here. I know you guys realize why I have not won any art awards. But you tell me what I can answer for you. What questions do you have?
So I have a
Anyone go.
question. So take me, my husband, we're both 1099s. So it fluctuates. Can someone like us do that? You know, because we don't know exactly what we're getting, like income coming in every month, but we do have a minimum. So my question be, like what would be the
Like, could the amount
amount?
change?
Yeah, because we do
So,
have it was like a savings account. You know, we got a couple grand in there. It's just willy-nilly,
mhm.
but I'd rather do this. Is that,
Well,
you know,
just so here's the first. That's a great question, Gail. The first thing I would always advise anyone is if you have a solo income in a household, I would recommend between 4 to 6 months of bills, 4 to 6 months put in a savings account. It can be a money market account. It can be a high interest yield savings account. But the bottom line is I need to access it in 24 hours. So you want that, and you want that liquid. If it is a dual income house, up to 3 months, because chances are both of the couple are not going to lose their job at the same